What if the collapse of the global economy didn't start with a war or a hack or a protest, but with a silent keystroke in Tokyo? No explosions, no headlines, just one fingertip, and $800 billion vanished from America's financial stronghold before Wall Street even had time to panic. Behind closed doors, Japan launched Shōgeki Zero, an economic first strike disguised as routine trading. But it was a cold, calculated precision that shattered 70 years of trust. And here's the terrifying truth, this was never about money. It was about respect, about power, about what happens when a proud nation is treated like a factory instead of a partner. So why did Japan strike now? Why is Canada quietly rerouting its entire trade map? And what terrifying treaty in Jakarta might end the dollar's reign for good? Watch closely, because this isn't just finance. This is the quiet birth of a new world when tariffs mocked a legacy. Morning Light in Nagoya found Toyota's electric vehicle research laboratory in uproar. A bank of screens displayed President Trump's speech from the previous evening, a declaration of 200% tariffs on all Mexico-assembled vehicles, including models from Toyota, Honda, and Mazda. Kenta Mori, chief designer of the Mirai sedan, slammed his wrench onto the workbench, the clang reverberating through the cavernous lab. He had spent years shepherding Japan's hybrid heritage. Now that legacy felt scrawled in insult across a campaign stage slogan. Engineers clustered around a station showing annual export figures. Over $37 billion in revenue reliant on United States and Mexican markets. The blunt declaration of "no more foreign freeloaders" cut through the room like a blade. Each assembly line worker knew that dismantling global supply chains could not be undone with a boardroom memo. Within hours, Japanese corporate executives drafted a freeze on further United States investments, a tit-for-tat that pointed toward Tokyo's silent weapon, its financial leverage. Rattled by headlines framing tariffs as triumphant populism, Japan's Industrial Council convened to escalate economic retaliation. The decision to liquidate Treasury holdings had been scheduled for weeks. The tariffs became its moral justification. As Mori watched his team absorb the blow, he realized the partnership between nations could dissolve faster than any metal alloy. $3 trillion gone before lunch. By the time the New York Stock Exchange opened its iron gates, market participants sensed a tremor. Citadel's bond desk phones lit up with urgent calls to the Federal Reserve. In just 6 hours, global equity capitalization evaporated by $3 trillion. Traders described the day as a full cardiac arrest. Assets that had seemed risk-free now gushed red ink. 10-year Treasury yields, once anchored at a comfortable 2.4%, leapt past 4% as institutional investors scrambled to rebalance portfolios. Jerome Powell, still chair under President Trump's second term, convened an emergency conference call with regional Federal Reserve presidents. The minutes captured strained voices debating repo operations and liquidity injections. Analysts warned of collateral damage, adjustable rate mortgages that would balloon, corporate loan margins that would contract, and pension funds that faced ruin without safe haven debt. Meanwhile, hedge funds offloaded blue-chip stocks in a rush for cash, triggering automated sell orders that roared through electronic markets. In London and Frankfurt, the ripple spread. By midday, European indices had veered sharply lower. Tokyo's Nikkei had already tumbled overnight. The unified shock demonstrated that United States Treasury bonds formed the fulcrum of global finance. And once dislodged, the world teetered. But while the titans of finance scrambled behind closed doors, it was kitchen tables, not trading floors, where the real fallout landed first. But the outlines were forming. A family of 4 meets the new dollar. That evening in Akron, Ohio, the Jennings family gathered around their kitchen table. Mark Jennings, a maintenance supervisor, and his wife, Lisa, a nurse practitioner, stared at their bank app. Their adjustable rate mortgage had crept from 3.5% to 7.5% in 2 weeks. Their youngest daughter, Emma, was pulled from daycare as weekly tuition became unaffordable. Grocery receipts showed a 40% jump in costs for staples, milk, bread, eggs. Pump prices near $6 per gallon made every errand a calculation in sacrifice. Local employers, facing higher borrowing costs and dwindling consumer spending, froze hiring. friends exchanged muted frustrations on neighborhood forums. No pay raises, fewer hours, and eroding savings. Retirement plans, once on track, now risked derailing under crushing debt service requirements. As Mark and Lisa recalibrated their budget to the nearest dollar, a palpable anxiety filled the room. Their dreams of a comfortable suburban life were cracking under a currency quake they barely understood. That night, the family shared headlines about Japan's bond sell-off, wondering how a decision half a world away could redefine their reality. Unseen by them, diplomats and bankers in Seoul and Jakarta prepared to pivot, quiet moves that would widen the chasm beneath American stability. We sifted through over 40 financial reports, leaked memos, and global trade data to show you exactly how the collapse started. Now you've got the full picture, before the headlines even caught up. If that kind of depth matters to you, hit subscribe. The quiet exit of friends, a signal blinked to life inside Seoul's Ministry of Strategy and Finance. And Jin Soo, South Korea's Deputy Prime Minister for International Affairs, reviewed a draft communiqué to be sent to counterparts in Jakarta and New Delhi. It outlined a pivotal shift. Transactions in yen would be phased out of bilateral contracts, and a new currency swap network would be activated to circumvent the United States dollar entirely. The message was brief, clinical, precise, but it marked the beginning of what insiders were calling the quiet defection of allies. In encrypted virtual meetings across Asia, ministers and governors agreed to hedge against further shocks from Washington. Behind the polished tone of diplomatic language was a mounting frustration. American trade policy, once seen as volatile but tolerable, had crossed into destabilizing. Countries that once counted on United States leadership now counted the cost of dependence. Energy contracts between Indonesia and South Korea were the first to transition. The yen, renminbi, and rupee formed the basis of new futures frameworks. Simultaneously, Vietnam shifted major semiconductor investments from dollar financing to domestic sovereign bond guarantees. It was not yet a rebellion, but the outlines were forming. From Southeast Asia to the Indian subcontinent, economic planners were turning away, not with noise but with numbers. In private, and Jin Soo confided to his staff, "The dollar won't collapse tomorrow, it will simply become optional." His words echoed in silence. By the time markets opened in London, commodity traders were already pricing in non-dollar terms. Asia's investment engine starts. Momentum didn't just gather, it detonated. In Jakarta, finance ministers from Japan, China, and India stepped onto the global stage with the unveiling of the Eastern Capital Grid, a $1 trillion investment initiative aimed squarely at dominating infrastructure, energy, and digital innovation across Asia. But here's what really turned heads. Not a single Western bank was invited. No JP Morgan, no Goldman, no London or Frankfurt representation. The message was clear. Asia was done waiting. The $1 trillion wasn't theoretical. It was pledged in local currencies. A bold move that sidestepped reliance on the US dollar. Ports in Indonesia, fiber networks in Vietnam, rail hubs in Thailand. These weren't pitches on paper. Ground was already being broken. And when Canadian Prime Minister Mark Carney showed up quietly and declined the customary handshake with the US delegates, his decision reverberated louder than any speech. Carney wasn't just a guest. He was a former central banker, and his silent posture screamed realignment. Soon after, Japanese pension funds began a slow-motion exit from US real estate, redirecting billions into Southeast Asian logistics, data centers, and renewable infrastructure. This wasn't just economic diversification. It was a philosophical pivot. The East was no longer looking outward for validation. It was building self-sustaining circuits of sovereign wealth. Then came the bombshell, the launch of the Eastern Monetary Authority, a joint effort by India and Japan. Along with it came a brand new credit rating system that explicitly rejected the influence of legacy agencies like Moody's and Fitch. Instead, ratings would be based on real-time data, ecological sustainability, and regional performance metrics, all processed outside the political filters of Washington or Brussels. As U.S. officials scrambled to interpret this silent coup in economic architecture, the global investment world began pricing in a future where the dollar was no longer the sun around which everything else revolved. The East was no longer responding, it was leading. Congressional blindfolds. Inside the Capitol, congressional aides rushed to prepare briefing folders. The emergency hearings had been scheduled after leaked cables confirmed Japan's coordinated sell-off had been predicted by a subset of intelligence analysts and ignored. Protesters gathered outside the marble halls with placards reading, "They knew and did nothing. Their chants echoing across the National Mall. Representative Marsha Parker, a Republican from Ohio and an unlikely bipartisan figure, grilled Treasury officials about what contingency plans had been made. The answers were evasive. Officials reiterated that tariffs were a strategic tool to secure domestic jobs. What they did not address was why foreign creditors were no longer playing along. Inside committee rooms, whispers of internal memos surfaced, warnings from the State Department's East Asia Bureau that Japan had signaled growing resentment since the second round of tariffs in 2024. Those warnings, it seemed, had been buried under electoral strategy. Cable networks aired split screens, lawmakers arguing over debt ceilings while ticker bars showed plunging export figures and rising interest rates. Meanwhile, Trump's press secretary insisted the tariffs were winning big. In private, however, campaign advisors were beginning to question the long-term optics of a collapsing alliance with America's oldest Pacific ally. Across town, the White House Economic Council met in silence, aware that no policy memo could reverse the global tide already in motion. Exports with nowhere to go. In the heartland, the economic theory felt painfully real. On a quiet morning in Des Moines, Iowa, Lisa Gutierrez stood in her soybean storage barn, staring at untouched crates. Her contracts with Chinese buyers had been priced in United States dollars. Now, without warning, they were null. Beijing had inked new agreements with Brazilian and Canadian exporters, transactions denominated in local currencies, not dollars. Lisa's crops had no destination. Over $20 billion in agricultural exports had been frozen or redirected in the span of 6 weeks. It wasn't just soybeans. Corn contracts were canceled. Pork shipments sat idle. Export markets were shifting toward countries that could provide price stability in a multi-currency world. Lisa called her contact at the USDA, but even government support systems seemed paralyzed. The Commodity Credit Corporation was overwhelmed. Insurance programs could not cover losses due to geopolitical repricing. Every dollar Lisa had borrowed to expand her storage facilities was now a ticking clock against an empty ledger. Meanwhile, Brazil surged into new global relevance as its agro-exports were rerouted into India and Southeast Asia. Canada, under Mark Carney's leadership, expanded bilateral agricultural trade with Japan at record speed. These deals circumvented dollar dependency entirely, reinforcing the idea that decoupling was not hypothetical. It was happening. At a small-town diner, Lisa met with other farmers. Nobody spoke in sweeping economic terms. They just wanted to know why, after all the talk of America first, they were the ones left holding the risk. Around them, the quiet hum of betrayal set in, strikes that span the map. It began with a murmur in Detroit, anxious whispers in break rooms, missed shifts, and murmured warnings that something big was coming. Within 72 hours, that whisper had turned into a roar. Auto workers by the tens of thousands spilled out of factories, marching with signs that read, "Tariffs took my tools," and "Bring back stability," not slogans. But this wasn't just Detroit. The walkouts spread like wildfire, down through Ohio, across Indiana, into Kentucky, Georgia, and deep into the heart of Texas. In less than 1 week, more than 500,000 workers were on strike, staging the largest coordinated labor action since the economic crisis of 2008. At the epicenter stood Jerome Dixon, president of one of the largest United Auto Workers chapters in the country. Standing atop a flatbed truck outside a locked assembly plant in Dearborn, Michigan, Dixon faced a sea of hard hats and calloused hands. "You can't tariff-proof the American dream," he bellowed, and the crowd roared in return. Dixon, once a quiet union negotiator known for compromise, had transformed into the voice of a fed-up working class. The demands weren't symbolic, they were survival-based. Workers wanted automatic cost-of-living adjustments as inflation battered paychecks. They pushed for job security clauses that tied employment to resilient supply chains, not overseas whims. And for the first time in labor history, they demanded tariff insurance, legal guarantees that contracts would remain valid even if international trade routes collapsed. In Washington, the Department of Labor scrambled to mediate. Emergency roundtables were called. Economists begged for de-escalation, but internally, White House advisors admitted they had never anticipated this level of backlash. What had been sold to the American people as a bold, nationalist economic strategy had turned into a domestic labor revolt. As walkouts spread to aerospace, electronics, and heavy equipment sectors, the message was deafening. This was no longer about policy, it was about survival. And for the first time in decades, the American worker wasn't asking for change. They were demanding it. The Capitol Exodus whisper. While workers protested in the streets, money whispered its exit through quiet channels. In Lower Manhattan, hedge funds started liquidating positions with a chill calm. In Zurich and Singapore, family offices rebalanced portfolios with subtle haste. No press releases, no statements, just the careful repositioning of capital away from the eye of the storm. Arjun Patel, an emerging market strategist managing high net worth accounts, had already moved 90% of his clients' equity exposure out of the United States. "We're not fleeing," he explained. "We're rotating toward reliability." For his firm, that meant Singaporean real estate, Vietnamese manufacturing indexes, and African renewable energy startups. By the sixth week of strikes and inflation shocks, an estimated $400 billion had been quietly extracted from United States equities. The Financial Crimes Enforcement Network flagged a surge in shell corporations formed in the Cayman Islands, Dubai, and the United Arab Emirates, many owned by familiar United States investors. Wall Street media, always slow to follow the quiet money, continued touting a resilient American economy. Meanwhile, mid-sized brokerage firms laid off analysts and shut down derivatives desks. This wasn't a crash, it was an elegant retreat, a rerouting of faith. The dollar, long seen as a one-way street for capital, was now facing two-way traffic. And those who recognized the change were already ahead of the curve, planning for a future where American markets were no longer the gravitational center of global wealth. Reserve myth unravels. The air in the International Monetary Fund headquarters felt thick. It wasn't panic, yet. It was something deeper. Institutional disillusionment. Kristalina Georgieva, standing before a hushed chamber in Washington, D.C., issued a veiled statement to member nations. It is prudent, immediate, and necessary to diversify reserve structures. She did not say the United States dollar was failing. She didn't have to. Behind her words was a mountain of data. The global share of reserves held in dollars had slipped below 50% for the first time since the 1990s. Central banks in Nigeria, Vietnam, and the United Arab Emirates had rebalanced their holdings. Even Germany, long a loyal dollar buyer, had reduced exposure by 10% in a single quarter. Saudi Arabia signed its first oil contracts priced in a basket of currencies that included the yuan and the yen. It wasn't just a symbolic move, it was a fundamental change in the mechanics of petrodollar circulation. At the Vienna Advisory Meeting, once dominated by United States influence, several members floated the idea of a rotating global reserve consortium, no longer pegged to any single nation's economy. The proposal was still vague, but the intent was unmistakable. On the streets of New York, most Americans were unaware. They still believed in the myth that the dollar was forever, that Wall Street would bounce back, that the rest of the world would wait. Yet inside the vaulted rooms of power, the myth was being quietly dismantled by the very institutions that once built it. Wine at the border, radar in the snow. Canada did not shout its defection. It acted with subtlety, intelligence, and precision. In Montreal, wine importers rerouted French shipments through Quebec-specific tariff structures, bypassing Washington entirely. In Alberta, shipments of German steel were unloaded with no United States Customs paperwork in sight. New corridors were opening, tariff-free, dollar-free, and defiantly independent. Prime Minister Mark Carney, often seen as a voice of global finance more than national politics, had authorized a series of quiet but profound shifts. Canada signed a bilateral defense pact with Australia, expanding Arctic and Pacific surveillance. Nunavut, once a frozen frontier, became home to joint intelligence facilities operated in tandem with New Zealand. Trade between Canada and the United States declined 17% over a 3-month stretch. It wasn't a boycott, it was a rebalancing, a recalibration away from dependency. When asked about the moves in a press conference, Carney simply said, nations must prepare for volatility by becoming structurally independent. It wasn't an attack, it was a forecast. In Washington, policymakers treated Canada's shifts as marginal, but analysts at the Rand Corporation and the Center for Strategic and International Studies were more blunt. If Canada walks, America stands alone. And while official narratives insisted all was well across the Arctic snowfields and beneath quiet trade terminals, it was becoming clear alliances were no longer guaranteed. They had become conditional, transactional, and subject to the winds of trust. Icebreakers missing at dawn. In the high Arctic, silence is more than eerie. It is strategic. American satellites captured images of Russian liquefied natural gas tankers slicing through the ice along the northern sea route. No flags, no declarations, just progress. China and Russia had quietly operationalized their new energy lifeline through the Arctic, bypassing not only the Panama Canal, but also any need to engage with United States naval patrols. At a near-deserted command post in Alaska, Rear Admiral Hayes watched the radar feed and shook his head. He had requested more funding for Arctic security 18 months earlier. The request was denied. Too expensive, too remote, too politically inconvenient. Meanwhile, Canada was not just watching. It was acting. Ottawa launched a fleet of autonomous drones designed specifically for polar reconnaissance, armed with artificial intelligence and infrared targeting systems. These drones patrolled the far north with zero coordination from the United States. Hayes and his dwindling team saw the writing on the wall. Their mission, once defined by joint defense, was now an exercise in quiet irrelevance. No reinforcements, no response plans, just bitter cold and bitterer truth. In Washington, Arctic oversight fell victim to bureaucratic confusion. Budget reallocations prioritized southern border deployments and military bases in the Indo-Pacific. The North, once imagined as a frontier of global competition, had been silently surrendered. Prices rise, pay slips shrink. While foreign powers redrew energy maps, Americans faced a more intimate war, one waged on grocery shelves, pay stubs, and hospital shifts. In Milwaukee, a nurse named Dana worked back-to-back night shifts, only to find her paycheck barely covered rent. Her hospital had frozen raises, citing macroeconomic instability. In Georgia, a public school teacher named Richard received his third deferred pay review notice. He canceled his dental appointment and started biking to work. "Not because I want to be healthy," he said, "because gas is $6 a gallon." At a Kansas distribution warehouse, managers slashed overtime hours while expecting full-shift productivity. Employees whispered about unionizing but feared layoffs. Meanwhile, prices for basic goods continued to surge. Bread, milk, over-the-counter medications, all creeping up faster than their incomes could adjust. The numbers were brutal. Real wages had dropped by 11% compared to the previous year. Retirement ages were pushed back. Second jobs became mandatory, not optional. The Consumer Confidence Index fell below its lowest point since the 2008 financial collapse. Still, politicians recycled talking points: transitory inflation, global adjustment, future prosperity. But in break rooms and family kitchens, those phrases rang hollow. Americans were not just stretched thin, they were breaking, not from sudden collapse, but from slow economic erosion that made every paycheck feel like sand slipping through fingers. And as the global monetary system shifted, average citizens bore the cost, not in theory, but in lived daily struggle. A treaty without stars and stripes. In Jakarta, cameras clicked as leaders from 15 nations stood beneath a new banner, one that did not include a single United States flag. The treaty signing was the culmination of 18 months of quiet negotiation, sparked by financial turmoil and finalized in full defiance of the old order. The agreement outlined the creation of a new digital reserve currency, backed not by oil or military strength, but by a composite of gold reserves, renewable energy output, and artificial intelligence productivity indices. It was a system designed for the 21st century, with rules that excluded the dollar and the United States banking system altogether. Mark Carney, attending in an observer role, offered no remarks. He didn't need to. His presence alone signaled endorsement from Canada, a G7 nation. Other Western allies, constrained by their own diplomatic entanglements, stayed silent, but their private sector quietly celebrated the shift. The numbers were astonishing. Over 60% of global trade volume pledged participation. This wasn't a rival to the dollar, it was a replacement plan, accelerated by the economic fallout of Trump's 200% tariff gamble. Back in Washington, the treaty triggered little more than a few editorials and cable news speculation. Lawmakers dismissed it as symbolic. Treasury officials gave non-answers. There was no plan to counter it. No coordinated response. Just denial. In real terms, this treaty marked a turning point. The global economy had moved on. It no longer required United States leadership. And for the first time in living memory, a major international financial framework was launched with no American fingerprints on its design. Which America emerges? In a high school gymnasium in suburban Illinois, folding chairs formed two opposing semicircles. On one side sat Maya Wynn, a robotics engineer recently laid off from an Illinois manufacturing hub. On the other, Ron Talbot, a retired veteran advocating for complete economic disengagement. Between them, Layla Grant, a 21-year-old college student live streaming the entire event. What began as a local town hall evolved into something much more raw. "We need to focus on localism. Keep our money here," Talbot said. Maya shot back, "We need trade to innovate. We need the world." It was more than a debate. It was a manifestation of a fractured national identity. One side demanded protectionism, tariffs, and sovereignty. The other sought integration, competition, and global participation. Neither group trusted the federal government. Across the country, new coalitions emerged. Mutual aid networks replaced state services. Third-party political movements surged, some preaching economic nationalism, others advocating decentralized democracy. A few even called for secession, not out of rebellion but pragmatism. The cultural divide deepened. In conservative enclaves, "Buy American or else" became more than a slogan. It was policy. In urban centers, innovation hubs formed barter systems and cryptocurrency-backed payrolls. The United States was no longer a singular economic organism. It had become a constellation of diverging realities. Some towns revived, others dissolved. Some believed the new order would bring resilience, others warned it marked decline. As the dust settled, one truth remained. The world had stopped waiting. Its treaties, technologies, and trade had moved on. Now, the United States faced a choice, not between left or right, but between reconstruction or refusal. The rest of the world had moved on. Now the question is, can we? What future do you see for America? Isolation or reinvention? Comment below. Your take might just spark the next conversation. Thanks.